So here's a puzzle for you. Duolingo just posted an absolutely blockbuster quarter. I mean, revenue's way up, users are surging, profits look incredible. So why on earth, on the morning they announced all this great news, did their stock price fall off a cliff? We're going to dive into this, because what's happening here is a really fascinating story. It's a clash between amazing performance today and a huge, risky bet on tomorrow. I mean, just look at this. This is what investors woke up to. Before the opening bell even rang, the stock was in an absolute freefall, down a staggering 25%. That is a brutal, brutal reaction, and it just seems totally disconnected from the headline numbers, which, when you see them, only makes this whole thing even more confusing. Because here's the first number from that same report: revenue, up 41% year over year. You know, that's not just good, that's incredible. That's the kind of acceleration you dream of for a company this big. And it wasn't just the money. The real lifeblood of Duolingo, its daily active users, surged by 36%. That's a new milestone. We're talking over 50 million people using the app every single day. So you gotta ask, right? What gives? How can a company report this kind of explosive growth and get absolutely hammered by the market? What are investors seeing that we aren't seeing in these glowing headlines? That's the big question we're gonna unpack right now. All right, so to really get to the bottom of this, we first have to appreciate just how good the quarter actually looked on paper. So let's just quickly run through the official results, because they really were fantastic. And what's wild here is just how consistent the growth is. I mean, look across the board. Daily active users up 36%, revenue up 41%, the number of people actually paying for a subscription up 34%. Even total bookings, which is a great indicator of future revenue, grew a super healthy 33%. And then you see that jaw-dropping net income figure. But there's a catch. Yeah, that enormous profit wasn't all from selling super Duolingo subscriptions. If you dig into the report, you find this little detail: a massive one-time tax benefit of over $222 million. So while the company is definitely profitable, that specific number is more of an accounting thing, not a sign that their core business suddenly exploded in profitability. The real story, the reason for that stock drop, it lies somewhere else entirely. And here we go. This is the heart of the matter. It wasn't the numbers from the past that spooked the market. Nope. It was what management said about the future. They basically announced they're making a deliberate strategic pivot. This quote right here from the CEO's letter to shareholders says it all. Duolingo is explicitly and publicly choosing to focus on getting more people to use the app over trying to make more money from the users they already have. They are intentionally tapping the brakes on monetization to play the long game. But what does that actually look like in the real world? Well, the CEO gave this brilliant example on the earnings call. So free users get a certain number of energy units every day to do lessons. If they run out, they either have to wait or, pay up. Now, the company knows for a fact that if they dropped the number of units from, say, 25 down to 24, more people would hit that paywall and subscribe. That would boost revenue right now. But it would also annoy some free users enough that they'd just stop using the app. And Duolingo just announced they're not going to make that trade anymore. They're choosing the user, even if it costs them a subscription today. So, what happens when you tell Wall Street, hey, we're going to focus a little less on making money right now? Well, it has immediate and pretty direct consequences for your financials. And this is exactly what investors heard loud and clear. This chart right here, this is the smoking gun. It shows the monster growth Duolingo just delivered right next to what they're projecting for the next quarter. Bookings growth is expected to slow from 33% all the way down to around 22%. Revenue growth goes from 41% to about 31%. That slowdown is the direct result of their new strategy. And for a high-flying growth stock, any sign of slamming on the brakes is a huge red flag for investors. Okay, so that explains the crash. But is the market right to panic? This creates a classic dilemma for any investor. So let's look at both sides, starting with the bull case, the argument that this is actually a really smart, visionary move. The argument here is basically play the long game. By focusing on user growth above all else, Duolingo is building a bigger moat around its business, making it harder for anyone else to compete. The potential market is still billions of people, and they want to capture the biggest slice of that pie they possibly can. The bet is that by investing heavily in AI to make the app teach better, they'll create a product so good that it will fuel growth for years, leading to a much, much bigger business down the road. They're trading a little growth today for what they hope is total domination tomorrow. But then, of course, you've got the other side of the coin, the bear case.
This is the perspective that drove that 25% drop, and it's rooted in the very real risks of that exact same strategy. The bears see a company that is actively, on purpose, slowing its own growth. They're giving up guaranteed money right now for a future payoff that is anything but certain. I mean, there's huge execution risk. What if these big investments in AI and teaching don't actually work out? And this concern got a lot more real when management admitted on the call that their premium AI tier, Duolingo Max, is already underperforming our lofty expectations. That kind of comment makes a big bet on future innovation feel a whole lot riskier.
So in the end, it all boils down to this one fundamental question. Is Duolingo making a brilliant, long-term strategic chess move to own the future of education and just accepting a little short-term pain to get there? Or is this a hugely expensive gamble, sacrificing real, tangible profits today for a future that might never pan out the way they hope? For anyone invested in Duolingo, the answer to that question is going to make all the difference.